China gold reserves might sound like a dry line item, but when the world's second largest economy eventually changes what it says it holds, markets can reprice narratives fast. And here's the tension. You can see calm on a gold chart, while the plumbing underneath, physical premiums, delivery terms, and cross-border flows, tells a very different story. Today, I'll give you 3 takeaways. A. What a China gold reserves update would actually mean and what it wouldn't. B. Why Shanghai pricing sometimes diverges from New York and London. And C. A simple framework to monitor the situation without getting whipsawed. And there's one detail most people miss that I'll explain later. The difference between a headline reserve number and the metal that's actually usable for settlement and collateral. Quick context on why this matters now. In recent years, central bank gold buying has been a steady theme globally, and China has also been pushing yuan internationalization through trade settlement, swap lines, and alternative payment rails. A public-facing reserves report is one piece of that, but not the only piece. Also, precious metals don't trade as one unified market. There's the paper layer, futures, unallocated accounts, ETFs, and the physical layer, bars, fabrication, delivery constraints. When those layers disagree, you often see it first in location-based premiums and unusual inventory movements. Before we go further, this is education, not financial advice, and I'm not telling you to buy or sell anything. The goal is to help you think in scenarios and understand mechanisms, because even if your portfolio has 0 gold or silver, the US dollar dominance story affects rates, inflation expectations, and risk sentiment. Let's start with the reserve question. China gold reserves can mean at least 3 things, and confusing them is how people get pulled into extreme conclusions. First, official central bank reserves, the figure the central bank reports. Second, broader state-linked holdings, gold held by other state entities, banks, or funds that may be strategic but not booked as central bank reserves. Third, domestic private holdings, gold owned by households and institutions inside China, which can still matter for policy flexibility even if it's not the state's gold. Why would official numbers differ from broader reality? Reporting choices, institutional boundaries, and incentives. A country may prefer gradual disclosure to avoid pushing prices against itself while accumulating, or to keep policy options open. Or it may simply be using an accounting framework that doesn't consolidate everything. So if you ever hear they must be hiding X, treat that as a hypothesis, not a fact. The market-relevant question is more practical. Would an update change confidence in the currency, change settlement behavior in trade, or change how counterparties assess collateral? Those channels are slower and more conditional than a one-day headline. Now, what could realistically trigger a meaningful moment where reserve messaging matters more than usual? Look for a combination of macro pressure and strategic opportunity. On the macro side, high sovereign debt loads, sticky inflation versus growth trade-offs, and changes in real yields can all shift the attractiveness of holding non-yielding assets like gold. On the strategic side, increased cross-border trade invoiced in yuan, new commodity contracts priced outside the dollar, and a desire to reduce sanctions vulnerability can make gold a reputational asset, something that signals balance sheet resilience. But even then, gold backing isn't a simple on-off switch. A currency isn't gold-backed because someone said a large number at a press conference. It becomes gold-linked only if convertibility rules, settlement mechanics, and trust are in place. That's why the same reserve number can mean very different things depending on policy design. The upside scenario, where the market treats a reserve update as credibility-enhancing, requires follow-through, consistent disclosure, clear settlement infrastructure, and willingness of trade partners to accept yuan claims with confidence. Without that, an update can become a short-lived media event rather than a structural shift. Next is the part that tends to move faster than reserve narratives, the spread between physical markets. People often ask, if the price is global, how can Shanghai be higher than New York? It's because the price you see is usually the marginal price of a specific contract at a specific venue with specific delivery rules, taxes, and capital controls. Here's a step-by-step way to think about a silver arbitrage when Shanghai prices trade above London, New York. 1. A local buyer in China bids aggressively for deliverable metal due to industrial demand, investment demand, or limited immediate supply. 2. The local venue reflects that urgency as a premium versus Western quotes, which may be more influenced by futures positioning and liquidity. 3. Traders compare the all-in landed cost, Metal price plus shipping, insurance, financing, taxes, and any administrative frictions to the expected sale price in the higher-priced market. 4. If the premium is large enough, metal tends to flow toward the market with the higher net price, because merchants and refiners respond to incentives. 5. Over time, either the premium narrows or inventories shift or policy changes alter the cost of moving metal. Notice what's missing. Nobody needs a grand theory. You just need a persistent enough gap after costs. To make that concrete, here's an example, purely hypothetical numbers, just to illustrate mechanics. Suppose silver is quoted at 25 in one hub and effectively 30 in another after local premiums. If shipping, insurance, and financing amount to 1%, and taxes or administrative costs add another one, a trader still sees 3% of potential gross margin. That's not risk-free. Prices can move during transit, rules can change, credit lines can tighten. But it's enough to motivate physical movement. When that happens at scale, it can show up as shrinking readily deliverable inventories at certain warehouses, rising lease rates, or higher fees for immediate delivery. This is why headlines about COMEX inventories or London Vault reports can matter. They're imperfect proxies for how tight deliverable supply is relative to paper claims. The key mechanism is simple. If one region persistently bids more for metal that can actually be delivered and used, metal tends to migrate in that direction, unless something stops it. So how does all of this connect back to China gold reserves and the US dollar? Think in two layers: settlement credibility and commodity security. On settlement credibility, a reserve update can be a signaling device. We have hard assets, we're serious about long-term stability. That could matter to trade partners deciding whether to accept more yuan exposure. On commodity security, persistent premiums in Asian markets can be a sign that physical material is valued more highly there, often because it feeds manufacturing supply chains, electronics, solar, medical devices, and defense applications. Silver is a great example because it's both monetary-ish and industrial. If a country imports large amounts of silver for manufacturing, it may prioritize securing supply over minimizing price. In the US and Europe, by contrast, price discovery often runs through deeper futures markets and financial positioning, which can temporarily detach the visible quote from immediate physical tightness. None of that guarantees a dollar collapse, but it does suggest a world where the margin of safety in strategic materials becomes a policy topic, not just a trader topic. And we've already seen governments pay more attention to critical minerals, supply chain resilience, and friendshoring. That's the macro bridge from metals into geopolitics. What should you watch next without getting pulled into daily noise? Start with 3 categories: messaging, market plumbing, and policy. Messaging includes any changes in how official reserves are reported, the cadence of updates, and whether there are parallel announcements about cross-border settlement, commodity pricing, or bilateral trade agreements. Market plumbing includes persistent Shanghai Gold Exchange premiums, deliverability conditions, refinery capacity utilization, and the relationship between spot pricing and nearby futures spreads. Policy includes trade restrictions, export controls, sanctions policy, and any coordinated efforts among allies around strategic stockpiles. Importantly, each category has a cause mechanism impact chain. Cause: demand for physical metal rises in one region. Mechanism: premiums widen and inventories shift. Impact: price discovery pressure eventually transmits to broader benchmarks, or policy reacts, or both. If you only look at the benchmark price candle, you may miss the mechanism and misread the impact. Now for the risks and the common mistakes people make with this story. First, volatility and timing risk. Reserve rumors can circulate for months, and premiums can disappear quickly if import rules change or credit tightens. Second, leverage and margin risk. Futures and leveraged ETFs can force you out at the worst time even if your long-term thesis is right. Third, liquidity and counterparty risk. Paper gold and paper silver exposures can behave differently than physical during stress, and not all products have the same redemption or custody structure. Fourth, regulation risk. Governments can change rules around imports, exports, taxes, reporting, and capital flows, which can alter arbitrage economics overnight. Fifth, narrative trap. Assuming every move is coordinated, markets often move due to incentives and constraints, not masterminds. If you want one simple analogy, use this. Regional metal pricing is like airline tickets. 2 cities can show different prices for the same seat because of taxes, capacity, and rules, and those differences can redirect traffic until prices normalize. Here's an actionable framework you can use as an investor to stay grounded. No predictions required. Step 1. Separate headline claims from verifiable signals. A rumored China gold reserves number is a claim, a persistent physical premium, or a repeated pattern in reporting cadence is a signal. Step 2. Build a small dashboard you check weekly, not hourly. Premiums, key inventory reports, real yields, and the dollar index trend. Step 3. Predefine your risk limits. How much volatility you can tolerate and what instruments you understand. Physical, allocated, ETFs, miners, or none at all. Step 4. Stress test scenarios. Ask, if the reserve update is smaller than expected, what breaks in my thesis? And if premiums narrow, what does that imply about physical tightness? Step 5. Avoid all or nothing positioning. Diversification and position sizing matter more than being early. And a quick what to track list. 1. Any official China gold reserves updates and their frequency. 2. Shanghai Gold Exchange premiums versus Western hubs. 3. COMEX inventories and delivery activity as a stress indicator. 4. Real interest rates and liquidity conditions. 5. Industrial demand signals like solar and electronics, trends. And 6. Policy headlines on critical minerals and trade settlement. Mini recap before we close. China gold reserves matter most as a credibility signal, not a magic switch. Physical premiums matter because they can reveal where immediate demand is strongest. Arbitrage matters because it's the bridge between regional markets, and it can move metal even when the benchmark price looks quiet. The dollar's role depends on many variables: rates, growth, geopolitics, and confidence. If you focus on mechanisms instead of narratives, you'll make fewer emotional decisions. If this helped, like and subscribe. This channel focuses on clear frameworks for confusing macro stories. And I'm curious, which indicator would change your mind the most? An official reserve update, sustained Shanghai premiums, or evidence of tightening deliverable inventories? One last risk reminder. Metals can be extremely volatile, premiums can reverse, and policy can change quickly. This is educational, not financial advice.